Pantheon AI presents Trade Deficit Plunges, AI Integration, Airbnb Slumps. Good morning, everyone, and welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and it's May 30th, 2025. What a crisp day out there in the markets, isn't it?
It really is host day. And as always, we're here to really break down the latest trends, all the news, and those crucial insights that affect your portfolios and, of course, your trading strategies. So, grab that coffee or tea if you prefer, and let's just dive right into what's happening in the financial world today.
Absolutely. Let's kick things off with a quick market overview. We're seeing some pretty mixed signals this morning across the major indexes. The S&P 500, for instance, closed at about 5,895.73, which is a slight dip, around 0.134% down.
Right, but then you look at the Dow Jones, and it actually posted a minor gain, hitting roughly 42,211.83. That's up about 0.046%. So a bit of a contrast there already.
Exactly. Meanwhile, the Nasdaq seems to be feeling a bit more pressure. It's fallen to around 19,074.72, which is a decline of roughly 0.295%. Not a huge drop, but noticeable.
And then the Russell 2000, not to be left out, actually saw a modest uptick. It's trading at about 2,068.13, an increase of roughly 0.0386%. So definitely a mixed bag across the board.
Indeed. Now, shifting gears to the crypto sector, Bitcoin is trading near 105,530.64. and it's experienced a marginal dip of about 0.045%.
Yeah, and Ethereum's seen a steeper decline, which is interesting. It's now sitting around 2,603.20, down by roughly 1.0818%. These figures really do remind us how volatile even established cryptocurrencies can be, don't they? You've really got to keep a watchful eye on that digital asset space.
You really do. So now that we've got that daily snapshot, let's move on to a deeper dive into some of the major market trends shaping the environment right now. There's this kind of air of cautious optimism out there, but it's mingling with whispers of uncertainty.
It's true. On one hand, even with some major stock indexes showing minimal movements, that slight uptick in the Dow Jones and Russell 2000 does suggest there's some underlying resilience in certain segments. It seems like investors are finding safe havens in more traditional sectors, opting for stability amidst all the market volatility. It's almost like the market's telling us fortune favors the patient,
It's a good point, but then those headwinds in the tech-heavy Nasdaq and the digital asset arena, they really raise a broader question, don't they? Are we just in the midst of a technical correction, or is there a more systemic adjustment on the horizon?
Yeah, some experts are definitely arguing that today's modest declines could be signaling bigger adjustments ahead as investors reassess valuations in key sectors. And speaking of reassessment, let's talk about what's been making news recently across the board.
Perfect segue. Our news roundup today brings us some pretty significant developments across a variety of sectors. Let's start with macroeconomic fundamentals. The big headline making waves is the reporting that the U.S. trade deficit in goods absolutely plummeted in April. Many believe this could point to a stronger second quarter GDP.
It's huge, right? Imports dropped by a record $19.8 billion, largely driven by lingering effects of tariffs and, interestingly, a shift in consumer behavior. The fact that major outlets are covering this so heavily just underscores how pivotal this change could be for the broader economy. That record drop in imports could really be fueling renewed confidence in domestic output and industrial performance, which would ripple through so many segments.
Absolutely. Switching gears to hospitality and travel, another headline grabbing attention is the analysis suggesting that Airbnb's stock is now a sell. Analysts are eyeing it cautiously, forecasting a weak summer for leisure travel. They're noting wavering consumer confidence, compounded by a decline in inbound international travel.
Yeah, and we've seen this before, right? Seasonal dynamics can be tricky. While some might say the market's overreacting, you can't ignore the data on declining price targets across the U.S. hotel sector. It's almost like the stock's current sentiment is a nod to a wait-and-see approach that might actually reward those who invest with a longer sight down the road.
That's a very fair point. Now, in today's tech realm, News is buzzing about how tech companies are really ramping up their internal initiatives by requiring employees to learn and use AI in their day-to-day work. This isn't just about staying trendy, is it?
No, it's a strategic move to boost operational efficiency and harness AI's power to stay competitive. Experts have been quick to weigh in, sharing both best practices and cautionary advice about potential pitfalls. They really emphasized that while AI adoption promises a transformational edge, there's definitely a right and a wrong way to integrate these tools. It's a bit like learning to ride a bicycle, you know? Once you find your balance, you're moving forward, but those initial spills can be pretty painful if you're not prepared.
That's a great analogy. And then there's the overarching financial mood, captured so succinctly by Bank of America strategist Michael Hartnett, who recently pointed out that, quote, markets are finally poised between a bullish breakout and a bearish breakdown. That's added a lot of fuel to the debate among investors.
It really has. His analysis suggests that while depth and liquidity remain robust, the market's momentum is undeniably at a critical juncture. This is where that classic interplay of risk and reward truly plays out, making the market such a fascinating puzzle that just keeps us all guessing. It's like waiting for the punchline of a joke, you know? Just when you think you know where it's headed, the unexpected twist comes in and leaves you thinking, well, I did not see that coming.
Exactly. So before we jump into sector-specific insights, let's just spend a moment on what these stories collectively might mean for you as investors. On one hand, those robust measures taken to reduce the trade deficit signal an economy that's striving for balance and could really be on the cusp of a period of higher domestic growth.
True. But on the other hand, sectors like travel and the stock performance of companies like Airbnb remind us that consumer sentiment remains a crucial variable. And that can swing markets faster than you can say diversification. Meanwhile, that tech sector's internal push towards AI integration, that might very well be a preview of the next wave of innovation that's going to redefine productivity and competitive advantage.
It's a lot to digest, isn't it? But being able to connect these dots is really what's going to give you an edge in this fast-evolving financial landscape.
Definitely. Let's take a moment to break down the sector analysis then. On the technology front, that increasing mandate for employees to adopt AI represents not only a fundamental shift in operational dynamics, but also a potential boon for companies that can successfully harness these innovations.
Right. This approach could lead to significant gains in efficiency and productivity. However, it's also a double-edged sword, right? Missteps in implementation could really lead to disruptions. The ongoing debate among tech leaders around best practices for integrating AI just underscores how transformative yet challenging this evolution can be. Tech companies really must be careful to avoid pitfalls, much like a chef who has to perfectly balance spices to create a delectable dish without overwhelming the palate.
That's a great way to put it. Now, turning our attention to the energy sector, although there hasn't been an overt headline today, it's important to consider that shifts in trade deficit dynamics and broader economic indicators could signal changes in energy consumption patterns. As domestic output strengthens, we might see increased demand and potentially tighter margins for fuel and industrial energy sources.
That's a really good point. Investors should definitely keep an eye on any policy changes or emerging data that could hint at a pivot in energy economics, particularly given that delicate balance of supply and demand that's defined this sector over the years.
Absolutely. In the financial realm, those slight gains in the Dow Jones and Russell 2000 do suggest that conservative investment avenues continue to hold appeal during times of market uncertainty. Financial institutions are, of course, adjusting their forecasts and risk models in anticipation of shifting consumer behavior amidst a slower international travel season and evolving global trade dynamics.
For banks and other financial entities, this environment presents both challenges in terms of credit risk management and opportunities to capitalize on rising domestic consumer spending. It's like walking a tightrope, isn't it? Maintaining balance while anticipating unexpected gusts of wind.
It really is. Now, looking at the global market implications, it's pretty clear that these domestic trends aren't isolated episodes. They're part of a broader tapestry that encompasses international trade, geopolitical shifts, and evolving technology adoption. That record drop in imports, for example, might not just be a domestic anomaly, but a signal that competing global supply chains are adapting to new trade policies.
And meanwhile, The cooling of leisure travel and those sector-specific recalibrations serve as early warnings for markets that are so closely intertwined with global tourism and economic cycles. As investors, you might ask yourselves, how much longer will these trends persist? And could a shift in international alliances or policy frameworks really send ripple effects across the global marketplace?
All of these questions bring us to today's expert insights and predictions. Some market strategists are predicting that the current market environment, characterized by these nuanced shifts rather than dramatic swings, could be the precursor to a more resolved period where individual sector performances diverge sharply.
For example, investors who've geared up for the next wave of technological advancements might find themselves reaping rewards if tech companies successfully deploy their new AI initiatives. Others in the travel and hospitality sectors, however, might experience more turbulence as consumer sentiment continues to waver.
And then there are those perennial debates around whether we're on the cusp of a broader economic expansion, as suggested by the shrinking trade deficit, or whether lingering uncertainties will just keep investors cautiously tethered to safer bets.
It's a lot to process, and sometimes, even as we navigate complex numbers and trends, it helps to remember that a little levity keeps the gears turning. If the market were a person, it might be that friend we all have who gets a bit nervous before a big party, calm on the surface, but secretly sweating over whether they left the oven on.
That's so true. In our case, it seems like the market is trying to find that perfect balance between optimism and caution, much like an acrobat performing their act on a thin wire. And, sometimes a good laugh really is the best way to take the edge off a challenging day in finance.
Couldn't agree more. Now let's drill down a bit more with some granular analysis by covering a series of important stories, each presenting its own set of implications for market participants. First and foremost, that U.S. trade deficit falling in April really stands as a beacon of hope for those betting on domestic economic resilience.
Definitely. When imports drop by a record $19.8 billion, it not only underscores the potential for a stronger second quarter GDP, but it also signals that our domestic industries might be eating a bigger slice of the economic pie. This shift has policymakers and economists closely monitoring everything from consumer spending habits to industrial production metrics, and it could really set the stage for an interesting fiscal environment in the months ahead.
It really could. And a related note, and speaking of strong signals versus cautionary tales, the repeated news about Airbnb's stock now being labeled a, quote, sell, has investors reevaluating their exposure to the leisure travel and hospitality sectors.
Yeah, analysts have adjusted their price targets downward across the U.S. hotel sector, suggesting a less than stellar summer ahead. One could say the travel industry is bracing itself like a guest arriving at a party where the host forgot to order the snacks. But seriously, these trends highlight some fundamental challenges, including fluctuating consumer confidence and fewer inbound international travelers, a phenomenon that could very well be tied to lingering geopolitical concerns or even changes in global health guidelines.
Good point. And then we come to the tech sphere, where a compelling narrative is unfolding as companies really ramp up their AI training programs. The proliferation of AI usage presents a host of promising opportunities, although it's not without its pitfalls.
True. Experts emphasize it's crucial for companies to adopt AI responsibly, ensuring staff aren't overwhelmed and systems are in place to handle any inadvertent quote-quote glitches. Picture it like a team of chefs learning a new recipe together. If everyone follows the right steps, you get a gourmet meal, but one misstep can lead to a kitchen disaster. In this case, though, the stakes are high, as successful AI adoption could lead to better decision-making processes, more accurate market analytics, and ultimately a competitive advantage in a rapidly evolving digital landscape.
That's a fantastic analogy. Overlaying these industry-specific narratives is that broader sentiment from market strategists who've characterized the current landscape as one where markets are finally poised between a bullish breakout and a bearish breakdown.
And with traditional equities, tech stocks, and even digital assets reflecting this dichotomy, the question for many is one of timing. When will the tipping point come, and in which direction will it swing? I find it especially intriguing how this precarious equilibrium forces investors to think twice about conventional wisdom. After all, is it better to ride the wave of optimistic momentum, or should one prudently wait for clearer signals before taking the plunge? It's a debate that's been going on for ages, and one that ensures market discussions remain anything but dull.
Never dull, that's for sure. We also have to consider the ripple effects these shifts are having on global markets. That record drop in imports, influencing domestic industrial performance, could have knock-on effects internationally as trade relationships adjust and supply chains realign.
Right. Meanwhile, the weakening sentiment in the leisure travel sector isn't just a U.S.-bound issue, but one that affects global tourism hubs, especially as other regions grapple with similar phenomena. And as tech companies worldwide ramp up their AI programs, this trend is likely to fuel innovation and potentially spur cross-border collaborations in tech research and development. You have to wonder, how might these global trends reshape the investment landscape over the next few years, and what does that mean for investors watching their international portfolios with keen interest?
Absolutely. Let's drill down even further with some detailed sector analysis. Beginning with technology, that push for AI adoption is already starting to yield early dividends. Companies that can effectively train their workforce on these advanced tools stand to benefit not only from enhanced efficiency, but also from the ability to better forecast and respond to market changes.
However, let's be honest, navigating this transition is no walk in the park. There are risks, including cybersecurity concerns and data privacy issues, that could add unforeseen costs down the road. From a long-term perspective, though, the integration of AI is seen as a worthwhile investment in human capital and digital innovation. It may just be the catalyst that propels the tech sector into a new era. And if you ever feel overwhelmed by the pace of change, just remember, even a supercomputer started with a few lines of code.
That's a great reminder. In the energy sector, while we haven't seen blockbuster headlines today, the sector remains incredibly sensitive to macroeconomic trends. That domestic focus on reducing the trade deficit could spell increased demand for energy as industries ramp up production.
Meanwhile, global adjustments in supply chains might limit oversupply in certain markets, thereby supporting prices over time. It's a delicate balancing act, and energy investors are keeping a close eye on everything from policy announcements to shifts in international market dynamics. In many ways, the energy market is like an intricate dance. One misstep, and the entire performance could be thrown off balance.
Indeed. The financial sector, often seen as the backbone of the overall market, is also navigating its own set of challenges. Although those slight increases in the Dow Jones and Russell 2000 offer a glimpse of stability, the atmosphere remains measured.
Yeah, banks and other financial institutions are carefully recalibrating their risk models in the wake of slow international travel and subdued consumer spending in certain sectors. Yet, there's also a silver lining here, as traditional financial institutions are exploring innovative technologies such as blockchain and more advanced analytics to better serve their customers and improve operational security. It's an exciting time for the financial realm, much like a suspense novel where the next chapter promises unexpected twists and turns.
I like that. So what does all of this mean for you, our valued listeners? The key takeaway here is one of balance and foresight. Whether you're leaning towards the resilience of traditional equities, exploring the promising but volatility-prone world of cryptocurrencies, or evaluating the transformative potential of AI and tech, the market is presenting opportunities layered with cautionary tales.
It's all about reading between the lines, understanding that every headline has its trade-offs, and making informed decisions that align with your investment goals and risk tolerance. And before we wrap up, I'm curious, how long do you think the current balance between bullish optimism and bearish caution will persist?
That's a great question. Are we on the verge of an innovation-driven boom fueled by successful AI integration? Or is there a risk that the next downturn could come from unexpected directions like geopolitical shifts or unforeseen supply chain disruptions? And in the broader context, what strategies are you considering to hedge against these uncertainties in your portfolio?
These are the questions we'll keep exploring. As we draw today's episode to a close, I'd like to extend a special shout-out to Pantheon AI, your information co-pilot, guiding you through the evolving labyrinth of market trends and economic shifts.
Remember, in these fast-paced financial times, staying informed and adaptable is the name of the game. I hope this briefing has provided you with useful insights and, of course, a few moments of levity along the way.
To all our listeners, thank you for joining us today. If you have any questions or need further clarification, don't hesitate to reach out and ask our AI co-pilot. You never know what gem of wisdom it might offer. And be sure to come back for the next episode tomorrow, where we'll continue to unpack the most pressing financial news and trends shaping our world.
And always remember, learning shouldn't feel like a full-time job. Have a fantastic day, everyone, and happy investing.
Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.